Hello, my name is Tim Sweeney. I'm a financial advisor with Tremblay Financial, and I've been helping people for about the last 35 years. I want to talk a little bit about the baby boomer dilemma, and that's something that we would like everybody to pay attention to as they approach retirement. One of the things that we like to focus on is risk management, risk mitigation. And when we look at investment portfolios and retirement portfolios, there's a lot of things to consider. One being inflation. The cost of goods and services going up is something that we have to be concerned about. There's tax risk that we have to be concerned about. We also have to worry about market volatility. Another thing that we need to talk about is what we call sequence of return risk. That's when the market kind of goes down or dramatically shifts without warning, and that can cause significant problems. And one of the last things is longevity risk. And so we have people that are living much longer than they used to when we were first having Social Security. People would live 5-10 years through retirement, but chances are a retirement is going to be more like 30 years. So the baby boomer dilemma is, how do you mitigate these risks, and how do you deal with an extended retirement period? And one thing that we need to look at first and foremost is how to sustain income. So if you're going to have a retirement period of 30 years, how are you going to be able to fund that and not run out of resources and not run out of an income stream? So one of the things that we take a look at is how we can do that. And one of the things that we like to first do is engineer a sustainable income. And the baby boomer dilemma is that reliance on 401ks and the market, when you have the risk of inflation and you have the risk of market volatility and you have a long period, is to basically plan for that sort of thing. And so we would tell people to take a look at and ask themselves 3 questions when looking at their retirement plan. 1, have they considered the impact of inflation in their retirement plan? Inflation can increase the cost of living by can double it within 20 years. And so if you have an income of $5,000 a month, 20 years from now you're going to need $10,000 a month. Or if you have a level income, you're going to be buying only 1 bag of groceries when you previously were buying 3. So one other question you might want to ask yourself is how taxes are going to affect your long-term plan. We have low tax rates right now, but taxes can erode and must be considered. And then last, we need to consider market volatility. We need to consider risk. And so if we look at investments that limit risk and we engineer sustainable income streams, we can ensure a much more enjoyable retirement. So if the answers to those questions are maybe, I'm not sure, then we would certainly encourage you to sit down and have a retirement plan assessment and a consultation that we would certainly enjoy providing.